Good morning, my name is David Sorensen. With me are my team members from Takapuna Grammar School, Lucy O, Alain Zhang, and Erjon Hossi. In acknowledgement of the Reserve Bank's Policy Targets Agreement and its goal to keep inflation between 1 to 3% in the medium term, we, the Reserve Bank, have today decided to hold the official cash rate at 3.0%. Although there have been improving economic conditions over the past year, we do not believe it is prudent at this stage to raise the official cash rate. This is in recognition of uncertainty around factors such as dairy prices and the housing market, and also the negative effects that a high currency bring. First on our agenda today, Lucy and Elaine will be discussing demand-side conditions, modeled off the components of the aggregate demand equation. Lucy will start with what is probably more positive, a relatively buoyant domestic economy, while Elaine will discuss what is a more uncertain international picture for New Zealand. Erjon will then discuss aggregate supply, and whether supply-side constraints in the economy are contributing to an output gap, and how this will affect inflation in the medium term. Finally, I will briefly conclude with some of the risks and limitations of our monetary policy decision, including factors like time lags and traction. I will also briefly discuss the possibility of future OCR rises into 2015. Lucy.
Since the 2008 recession, real GDP growth has rebounded strongly to an annual 3.3% in the most recent quarter. This strong growth could potentially lead to a positive output gap. However, there are some signs growth is slowing. One indication of this is the ANZ Truckometer Index, which measures the number of heavy vehicles on key New Zealand roads, and has been dropping recently. The index generally precedes GDP growth by 9 months, and so this data indicates that New Zealand may be nearing the top of the current business cycle. Unemployment has also remained stubbornly high since the recession, and is currently around 6% seasonally adjusted. This may ease inflationary pressures, as it will slow overall consumption spending and provide relief for some labour shortages. There has been very strong house price inflation, particularly in Auckland. This is contributing to the wealth effect and is acting as a strong inflationary pressure. Reserve Bank macroprudential measures were introduced in October 2013 to cool the market and encourage responsible lending, and overall the market is easing from late 2013 highs. Due to a low OCR, the cost of debt servicing has gone down considerably despite debt levels remaining high. This means any OCR rises will have significant traction in the economy as disposable income is eroded and consumption slows. Wage growth has been slow since 2008, not far above inflation. It is showing possible signs of upturn, but several years of low growth may be suppressing the current consumption spending and inflationary pressures. Consumer confidence is historically high. It drops soon after news of OCR rises, an example of the immediate traction that monetary policy can have well before interest rates actually take effect. The government is aiming for a slim surplus in the 2014 to 15 fiscal year, with a forecast to grow over the coming years. This will act as a deflationary pressure since taxes will be higher than government expenditure, reducing demand overall in the economy. Likewise, public service employees will experience lower real wage growth, impacting aggregate demand.
International factors. The New Zealand dollar has remained its near record high so far into 2014. Despite predictions it may fall, the New Zealand dollar is well above its long-term average, and the International Monetary Fund has estimated it is up to 15% overvalued. The reason for this is clear from the contrasting investment returns in New Zealand and other countries, as shown here, because the Federal Reserve has indicated it won't be rising interest rate until 2015. Any OCR rises will increase the current differential, making New Zealand investment more favorable and increasing demand for New Zealand dollar. The high New Zealand dollar eases inflationary pressure since it weakens export earnings, particularly in tourism and agriculture, and keeps the price of imported goods down. A slide in dairy prices, especially when coupled with a high exchange rate, is shaping as a major issue. Although this comes about from a natural adjustment to last year's supply shortage, it will still have a large effect on the economy, particularly in rural areas. New Zealand exports have become increasingly dairy-orientated, and this will have a significant effect on the consumption in the economy, easing some inflationary pressure. Growth in China, now our largest trading partners, appears to be slowing slightly, although still relatively high. Likewise, our other major trading partners, the European Union, the United States, and Australia, are still undergoing a recovery. Preliminary data has shown that although the US has recovered from a poor GDP growth in the first quarter of 2014, Australia, and particularly European Union, have had weak growth in the second quarter of 2014. This has resulted in slightly subdued export growth, flowing onto less demand in the economy.
Inflation in the second quarter of 2014 was only 1.6%, well down on what many analysts expected it to be, around 1.9%. This is well within the target band of 1 to 3%, and still below the target midpoint of 2%. However, we need to consider the associated time lag of effective monetary policy, about 12 to 18 months, and assess building inflationary and deflationary pressures, not just headline inflation. Despite the associated time lag, these inflationary figures give some evidence that Reserve Bank policy, among other factors, is already having an effect on inflationary pressures in New Zealand. The Reserve Bank has recently stated that the negative output gap has been significantly reduced, and if aggregate demand continues to grow, as it has been, without a coinciding growth in firms' potential output, then a positive output gap will emerge. This scenario is looking likely, with supply-side constraints growing. Capacity utilization is up from the March quarter, and as you can see here, is now above 90%. Because businesses are nearing their peak capacity of output, if new demand emerges, they will struggle to increase output while keeping costs low. This will cause strong inflationary pressure in the New Zealand economy. Likewise, labour shortages are shaping up to be a strong inflationary pressure. In an interview we recently had with Stephen Topless, Mr. Topless talked of how businesses BNZ are dealing with are struggling with these labour shortages, particularly skilled labour. He also mentioned the trade-off of our currently very high net migration inflows. Although new migrants will have an easing effect on labour shortages in the long run, in the short run they will lend to inflationary pressure, for example by putting more pressure on the housing market. Recent OCR rises have already had an effect on business conditions in New Zealand, with business confidence down. Rural areas especially are struggling with low commodity prices, something the recent quarterly survey of business opinion from the New Zealand Institute of Economic Research highlighted. Indeed, they found that if current supply-side constraints are coupled with current demand, businesses will need to raise their prices in the region of 2.5% per year over the next couple of years. This slide summarizes the main inflationary and deflationary pressures in the New Zealand economy. To clarify, some of the uncertainty affecting our decision arises from the possible effects of a downturn in the housing market and the fact that consumer spending seems to be easing somewhat.
In New Zealand, there is a high level of indebtedness. Household bank debt now surpasses 200 billion New Zealand dollars for the first time. This means that our monetary policy decision will have significant traction, since interest rates heavily affect how most consumers spend. 95% of this bank debt is in the form of mortgages, and 70% of mortgages in New Zealand are now on fixed rates. This means that there will be a time lag before the full effects of our decision are felt among all New Zealanders. A major risk of our decision is that economic factors could change into the future and lead to strong inflationary pressures. In particular, if our OCR hold reignites new lending in the housing market, or if commodity prices rebound from their recent lows, then we may need to readjust the OCR upwards. Likewise, we will need to evaluate the effect of previous OCR rises in 2014. A general economic upturn, domestically and internationally, means that monetary policy will soon need to contract. However, we do not believe that now is the time. In 2015, as other major economies look to increase their interest rates, we too may follow suit and raise the OCR. Crucially, a rise then will be putting less upward pressure on the New Zealand dollar and will ease some of the inflationary pressures that we believe could begin to emerge beyond 2015. In our June written statement, we highlighted several unpredictable economic factors that could potentially be deflationary. For example, a fall in dairy prices or an easing of the housing market. Since that time, uncertainty around these figures has in fact only grown worse, and contractionary monetary policy risks pushing the economy towards deflation if these worsen further. Likewise, a high OCR has significant risks and limitations involved with the high New Zealand dollar it would bring. With these factors in mind, we do not believe that it is prudent or necessary to raise the official cash rate at this time, and we are confident in our decision that to ensure price stability over the medium term, holding the official cash rate at 3.0% is the best option. Thank you for listening.
Cool, thank you. So I'll start off with the first question. So you've talked about where you see interest rates going in the future and when you expect to raise them. Why might the Reserve Bank want to give an indication of where interest rates are going in the future?
So I think it comes back to, why you need to, why businesses need to be able to plan, for example.
Yeah.
Well, that's because of multiple factors, like they have to plan how much workers they're going to employ or how
Yeah,
much
so-
resources they're going to need for the future.
Yeah, and especially if you're looking at some form of investment, looking at what interest rates are going to be in the future is pretty crucial to know. So you don't want to make some sort of investment and then have interest rates shoot up a lot, because if you look back in the times, before the Reserve Bank Act, when you had a lot of inflation in the economy, it was very uncertain for businesses, and as a result, the economy really stalled quite badly. What about effects for consumers?
Well, it might affect whether they go onto fixed or floating mortgages in the future.
Yeah, certainly. So I think banks will need to change their fixed and floating rates depending on if they think that the OCR is going to rise. They may have to raise their fixed rates to higher to compensate for future rises. Anything else, or just? Okay.
Yeah.
Do you want me to summarize? Okay.
Yeah.
So basically, the Reserve Bank needs to give an indication of where the OCR is going in the future, so that businesses and consumers have a level of confidence and an idea of how they can plan ahead for what the cash rate is going to be. So, for example, businesses in a more long-term view may need to know what interest rates will be if they're making new investments and borrowing money for that. And likewise, consumers and banks even will have to know where interest rates are going in terms of fixed and floating mortgages. And if there's a level of uncertainty, it makes it very difficult for the economy to function well.
Okay. Can you explain the role of inflation expectations in inflation?
Sorry, can you say that again, please?
How does inflation expectations contribute to inflation?
Oh, okay. So I think you're looking at sort of
So you're looking at-
inflationary, deflationary spirals.
Right. Okay. So it's got a lot to
Yeah.
do with consumer confidence.
Yeah, so if people think that, for example, why deflation is so dangerous, because if people think that prices are going to go down,
Then
Yeah, then they're gonna stop their consumption for now because they're expecting the price
yeah, the
to
real
fall
value,
further.
the real value of the money will
Yes.
actually go up. So that, in a sense, it contributes itself, because
Yeah.
Yeah.
then it pushes the country further and further into deflation.
Yeah, because it will also lower the firm's revenue, which costs there will be a lower investment.
Yeah, so firms have difficulty with this. And what
Yeah.
about inflationary?
Well, it's really
Spirals.
similar because if the consumers know there's going to be inflation very soon, they're not going to save as much.
Mm-hmm.
so it'll cause more spending before the
Yeah.
price of goods
It'll
does get
cause more
increased.
inflation.
Okay, and that just causes even more.
Yeah.
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 Okay. Do you want to summarize that one?
And-
Or is there anything
And
else?
also, inflation, it will also contribute to a higher menu cost.
Yeah,
because-
so the sort of
yeah.
costs associated, so you're looking at,
Cost associated. And also the confidence about business and consumer confidence is going to be dropped.
Yeah, especially if you
Yeah.
look at something like deflation.
Yes, especially
Confidence
inflation.
might go down, and then as a result, that inflationary expectation
Yeah.
actually ends up impacting inflation because people pull back their spending.
Yeah.
And likewise with inflation, if people have an expectation that inflation's really big, they're probably going to want to spend more money
Yeah.
Yeah.
sooner. Okay. So do you want to summarize that?
Okay. So the way inflation expectations actually influence inflation are through inflationary and deflationary spirals. So if consumers are expecting a deflation in the economy, then they might hold their money, which will cause further deflation. Or if the expectation is that there will be quite high inflation, they might rush off to spend it, which would increase aggregate demand and cause more inflation.
Okay, good. If expectations are so important, how can the Reserve Bank help manage those expectations?
Well, I think that's. I think in the modern environment, people have a lot of confidence in the Reserve Bank. So certainly, back when the Reserve Bank first started, maybe they'd had so many years of inflation, they didn't really
Yeah.
I think that they can
believe
make
that the Reserve
targets.
Bank can have an effect. But now it's been 20 years or so
Yeah.
of the Reserve Bank hitting those policy targets. So
Yeah, so if you look back at the 1980s, well, it will have to be really hugely increasing interest rate will have an effect because people are not so confident
yeah.
about the Reserve Bank.
because I've seen cartoons and stuff
Yeah,
from when the Reserve Bank Act was passed about people sort of saying the Reserve Bank,
Yeah.
there's no way that they could possibly keep inflation down.
Yeah.
But I think now there's been such a long period of low inflation, or inflation within the target band, that people are actually confident. So it's that idea, but of sort of jawboning, if the Reserve Bank says something,
yeah.
And we're also seeing some evidence of that in our current exchange rate, for example. It went quite high because the
Yeah.
market was pricing in an OCR rise.
Yeah, people often, what the Reserve Bank says in their statements and stuff actually has a quite immediate impact on the market and those kinds of things. So I guess people just trust the Reserve Bank, really, don't they?
Also, the recent lowered business confidence and consumer confidence is
Right.
also
Yeah.
example.
So people
Yeah.
know straight away.
And it's not necessarily a result of the OCR rise, but possibly perceived OCR rises in
Yeah.
the future.
Okay. Yeah. So because the Reserve Bank, has been operating for over 20 years now in its modern sense, targeting inflation, it's been very successful with that over the past 20 years. So people really have a level of trust, I guess, that when the Reserve Bank says they're going to keep interest rates in that target band over the medium term, they have real trust that they actually will be capable of doing that. So people know that if the Reserve Bank says inflation is probably going to be this much, people trust that, and so as a result you get rid of that sort of idea of maybe people putting off spending or suddenly doing a lot of spending because they trust the Reserve Bank's ability, because it's been shown over many years to actually impact inflation.
Okay, thank you.
So how could the Christchurch rebuild affect the New Zealand economy and in particular domestic inflationary pressures? So if you could answer this question applying both economic theory as well as knowledge of what's happening in Christchurch at the moment.
So I think the first thing you'd definitely be seeing is you're seeing a huge amount of insurance money flowing into Christchurch, into the Canterbury rebuild.
Mm-hmm.
So that's going to be increasing a lot of aggregate demand in Canterbury.
Yeah.
So in terms of just in Canterbury, there'll be strong inflation. There's been a lot of infrastructure damage, a lot of housing damage, a huge amount of claims through the EQC and that kind of thing.
Yeah. And the fact that there's a lot of construction going on in Christchurch, like Canterbury, it just means that aggregate demand will actually increase.
Yeah, definitely. Construction. I mean, you're looking at, first quarter GDP figures, a huge 1% GDP growth. A huge amount of that was construction. It was like 12% growth just in construction. And that's coming mainly, part of it's part of Auckland, but a large amount of it from Christchurch. So I guess the rebuild, ultimately it's an inflationary pressure, right?
And also you have to consider part of the money supply for that rebuild is coming from the government.
Mm-hmm.
So there's also a slightly increasing government spending, which affects
certainly.
Yeah.
You look at those massive government deficits,
Yeah.
and 2011 and stuff, and 2012 came on the back of a huge amount of spending in Christchurch.
Yeah.
But I think if you look at domestic inflation overall, Christchurch certainly is experiencing a lot of inflation in terms of house price and that kind of thing.
Yeah.
But you look at rural areas. I was reading just this morning actually about how, looking at regions, a place like Wellington is experiencing negative growth, whereas areas like Auckland and Christchurch are just taking off. And so perhaps the declining commodity prices in the rural areas is really affecting some of that inflationary pressure in Christchurch.
Even the house price.
And so a lot of that comes from the housing shortage we're experiencing, because we have quite high house price inflation, which is a result
in
of
Christchurch especially, you have a huge amount of workers going down. You have, I know people even in Auckland who have businesses that have moved down to Christchurch to do contracting work and that kind of thing. And it's that sort of flow of people and of money into Christchurch that's really going to be causing inflationary pressure.
And that's also contributing to labour shortages. So you have all these construction workers over there, and that could cause a wage increase even. Yeah,
particularly wage inflation in the construction sector suddenly. And then you have to think as well about what the rebuild in Christchurch is doing. So it's effectively increasing supply in the longer term. So in the short term, maybe there's that boon of construction and everything, but probably in the longer term, it's actually could potentially even be deflationary because it's increasing supply.
Yeah.
Mm-hmm. And so there's also the recent slowdown of our GDP growth, and that could be due to that construction possibly. So if that construction was affecting our GDP.
Yeah, it could. If construction's too large a proportion, GDP in the future, it could be easing off.
Yep.
Okay. So basically in Christchurch at the moment with the rebuild, there's a huge amount of money flowing into Christchurch from insurers, from the EQC, from the government, from consumers just rebuilding their houses and that kind of thing. And that's leading to a massive boom in construction there. And that's being really quite heavily inflationary in Christchurch because workers going down, they have to find somewhere to stay, which is increasing house prices, increasing the general price level in Christchurch. However, in terms of the overall domestic inflation, it's probably tempered slightly by the fact that you're seeing negative growth rates in some of the rural areas. So while you have Auckland and Christchurch as very strongly inflationary, you perhaps also have those rural areas being hit by falling commodity prices and those kinds of things that are acting as a sort of balancing deflationary pressure. And we're also saying in the long run, the Christchurch rebuild is actually possibly deflationary, because in effect it's increasing the aggregate supply of the economy, because you're building, new factories, new houses, those kinds of things in Christchurch. So on balance, I guess it is strongly inflationary in Christchurch, but over the whole economy, and in the long term, it's probably tempered slightly by lower growth rates in other areas.
So you've talked a bit about falling commodity prices. So generally when we see commodity prices fall, we see the exchange rate depreciate as well. So to date we've seen large falls in commodity prices, but no consequent fall in the exchange rate to the same extent. Why do you think the exchange rate has not fallen?
I think first what we have to consider is the really high, the increased differential that we're experiencing, because, for instance, European Union, they're all applying really expansionary monetary
almost
policy.
zero, and Europe even
almost zero.
negative interest rates.
Yeah, and also that United States are also using quantitative easing.
Yeah, so the
which is,
relative value of
yeah,
the currency is going
it's
down.
They're still
hugely
climbing
negative.
towards their pre-recession highs.
Yeah.
Yeah, so that in other countries around the world, the monetary policy is still very expansionary.
Yeah.
I think I saw it described the other day actually as people thought it was an arm wrestle between high commodity prices and interest rate differentials. But now what's happened is commodity prices have gone down, but interest rates have, the exchange rate has stayed high.
Yeah.
So I think really the interest rate differential is winning that arm
Yeah.
wrestle.
Yeah. Also because falling commodity price is partially kind of due to the general economic environment, worldwide, is they're still recovering.
Yeah.
Not like their demand are not as strong as they were before.
Yeah. So demand in China and stuff maybe
Yeah.
tapering off. I think as well, if you think about if you were an investor, say in the U.S., and you can go and you can borrow from the U.S., you can get treasury bonds or something
Yeah.
at practically no interest rate, or you can borrow that money at practically zero interest rates, then come to New Zealand and you're looking at much higher interest rates. It's that sort of investor demand, and I think we have to consider how small New Zealand really is on a world stage in terms of those currency markets and that kind of thing. And so
So that comparative returns is probably the biggest factor affecting our exchange rate, but there's also that high net migration. So all these migrants coming to the country are going to be buying New Zealand dollars,
Yeah.
and that
Yeah.
will also
Certainly.
be having an effect on our exchange rate.
Yeah, so that's the interest rate differential means that it's probably it's tempting for investors to invest in New Zealand. Increasing demand for the New Zealand dollar increases the rate, even though commodity prices are falling, and that is like you said, that is quite unusual, and it's really actually pretty dangerous as well, because normally you'd expect an almost sort of hedge, because as commodity prices come down, the dollar comes down as well. But if you have commodity prices coming down and the dollar staying high, that could be a potentially very negative situation.
It's one of the biggest influences on our decision to hold because of that.
Yeah, certainly. That sort of conundrum facing it. So do you want to...
You got it.
Okay. Okay, so the basic reason why we're seeing such a high New Zealand dollar at the moment is there's quite a big, as you saw in one of our slides, there's quite a big interest rate differential between what we have in New Zealand and what we have overseas. So New Zealand's interest rates tend to be structurally higher anyway, but we also have much more contractionary monetary policy than, for example, the US or the EU, who have zero or even below zero in the European Union interest rates. And so as a result, it's very tempting for investors to come and park their money in New Zealand. And it's that sort of force of the global currency market in the global world, for just a small country of 4.5 million people, that we're sort of like a ship on the rough seas. We can't really have a huge influence over that. And so even though commodity prices have come down, the demand for New Zealand dollars, because of our higher interest rates, is just so much stronger than that downwards force on it.
So a follow-up on that. If the exchange rate does not fall further, what could be the consequences for inflation?
If the exchange rate doesn't fall further? Okay.
Okay, so, the exchange rate had fallen from 0.89 to 0.8.
It's fallen a little bit over the past couple of weeks.
But it's still overvalued.
Still overvalued.
Yeah. So I think it's like the main factor will be it will be a deflationary. because the price of imported goods will certainly keep kept down.
Yeah, I think if you
Which
look,
is-
yeah, like
yeah.
think about tradables inflation. You know,
Yeah.
it's
Yeah.
practically deflationary. The tradables
Yeah.
inflation with such a high New Zealand dollar. So
Yeah, and also because it weakens export earning, as we mentioned in our slides.
yeah, so if
Yeah.
you're a New Zealand farmer or something, New Zealand dollar staying high, you're really going to be struggling.
Yeah.
And especially if the commodity price is so low, it's gonna have a really bad effect on the.
Yeah, so combined with
Yeah.
the commodity prices, certainly, yeah. Okay, so we have the tradables inflation is almost deflationary, which will be keeping the general sort of headline rate of inflation quite strongly down. And also, New Zealand exporters will be struggling to attain competitiveness
Yeah.
overseas, so that's holding down. Do you want to do that one, Elaine?
Yeah, sure. So now, as we are experiencing a falling in commodity price, so this will be, and also a high exchange rate, and if it doesn't fall further, this will be a strong deflationary pressure on the economy, because, well, it will keep the price of input goods down, so the tradable inflation will be down, and it will also decrease the competitiveness of New Zealand exports in foreign market, which will decrease our export foreign sectors in the aggregate demand. So that will be strongly deflationary if the exchange rate still kept high.
Given what you've talked about, should the Reserve Bank intervene in the exchange rate?
Yeah, I think it's sort of a conundrum, really, isn't it? Because I think that, remember what Stephen Topless was saying, that,
there's 100 billion New Zealand dollars
Yeah.
traded
every day.
every
Yeah.
single day.
And so the Reserve Bank just simply, because the most common form of intervention would be to sell New Zealand dollars into the market.
Yeah.
But I'm not sure if the Reserve Bank has the currency reserves to make an influence over the sort of interest rate differential.
Yeah.
So I think one thing that what Stephen Topless was actually saying to us was that you'd have to
need to be matched with an OCR, either lowering or holding. So
Yeah,
it would
lowering
need to
or
be,
hold.
the comparative returns would need to actually change, as well as the
Yeah.
exchange rate, probably.
Mhm.
Because we're such a small open economy,
Yeah,
it's
you
really
don't.
difficult to.
You can't really have that two forces tugging each way. You can't have,
Yeah.
on the one hand, you're selling New Zealand dollars,
On the other
But on
hand,
the
it's
other hand-
a smart investment.
you're keeping the interest rates high. So
Mhm.
I think that, but I think, do you think we should intervene? I think we should, because I think there should some sort of form of intervention.
Intervention, but not by moving the exchange rate. It's
Yeah, because in effect, holding the OCR like we are is a form
It's-
of intervention.
Mm-hmm.
Because by holding it, we are, if
Yeah.
the Reserve Bank did hold interest rates at 3.0%, you have the currency already priced in at a much higher expectation of
Mhm.
the OCR.
so it would fall.
So it
even
would
further.
come down quite a bit.
Yeah.
And I think at that stage, once you have it falling, then's probably the time to start selling New Zealand dollars to intervene. Because at that point, you're not fighting against a headwind.
Mm.
You can go along with
Yeah.
it. Okay.
So-
Because I think the high New Zealand dollar, at the moment, it's very, it's overvalued and it's sort of too high. I mean, even Graham Wheeler's talked about it, about it's being overvalued. And even when he said that, markets didn't actually drop that much, which says a lot, I guess, about the interest rate differentials.
Mhm.
Okay, do you
So we think with the quantity of New Zealand dollars being traded every day, if the Reserve Bank does decide to sell New Zealand dollars, it won't have as much of an impact because of our current interest rate differentials. So with our high interest rate, it's still going to attract investors in the medium to long term. However, a hold or a lowering of our OCR first would have more of an impact on those investors, and then afterwards, by possibly selling New Zealand dollars, we would have a lowering our exchange rate.
Thanks.
Do we have time for one more?
1 minute.
One more question. Oh, do you want me to go?
Yeah.
Okay, very good. Can you talk through the implications of inflation and activity in the New Zealand economy from New Zealand's savings rate?
Sorry, the effect of...
So think about New Zealand's savings rate. It's typically been shown that we're quite bad savers. What does that mean for inflation and activity here?
Okay, so I think if you look at the effect that, because New Zealanders tend not to save much,
Yeah.
you're always looking at a constant current account deficit, because New Zealanders in effect can't fund the investment that's necessary for New Zealand. And I think it's been the news recently with those farm sales and stuff.
Yeah.
That's really a direct result of there's just not enough New Zealand in savings to fund those investments.
And also because we don't save as much, we use a lot of money for consumer spending, so consumption.
But I guess you think ultimately overall what effect it will have on inflation. Because people are saving less, in the end it leads to less investment in the New Zealand economy.
Mm-hmm.
Right? We simply don't have the capital or the savings to fund the investments that might be needed to ease some inflation. So I guess ultimately it could be quite inflationary, really, couldn't it? Because
although it's kind of deflationary in the short term, but
exactly. So yes, in the short term it's probably slightly deflationary.
Yeah.
Because business investment in general in the short term is probably quite inflationary. And so if there's not much of it going on in New Zealand because we don't have the savings, then that would lead to less things like construction stuff in the short term, which could be inflationary.
Yeah.
But I think in the long term, because we don't save much, we rely on foreign capital to fund our investments. And I think that maybe that doesn't make up. If you're a New Zealand business, it might be difficult to get hold of cheap domestic money to invest with.
Despite the fact that New Zealanders are bad savers, most New Zealanders invest most of their equity in their own houses.
In the houses,
in the form of mortgages.
Yeah, and that's interesting because house price inflation isn't counted in the CPI. So there might be strong house price inflation because New Zealanders are parking all their money in the equity on their house, but that probably doesn't come across in the headline inflation. So I guess it's sort of that balance of things.
Yeah.
Okay, so to summarize, because New Zealanders tend not to save as much as they perhaps should, it can be difficult for New Zealand firms and for New Zealand businesses to get hold of money to invest with. And that's why we see a lot of foreign capital coming in, so a lot of foreign ownership of land and those kinds of things. And so as a result, in the short run, that's potentially deflationary because there's not as much economic activity going on. But in the longer run, it's inflationary because New Zealand businesses aren't building up their ability. They're not building up that ability to increase their output, which will be deflationary because it'll ease that aggregate demand. But like Erjan was saying, there's also the possibility that because New Zealanders tend not to save as much in the bank, a lot of their money is parked in the equity of their house. And so that could certainly be quite deflationary because there's house price inflation, but it doesn't come across in the headline level of inflation as it might if those people were saving that money and investing it in new construction, those kinds of things.
Okay, good. Thank you. Oh, we're done. I think we're out of time. So you can relax now. Thank you for your contribution.